Good afternoon, everyone, and thank you for joining today's Crush Your Student Loan webinar. My name is Migdalia Gomez, and I'm the Community Engagement Manager at the Harvard University Employees Credit Union. So before we get into today's presentation and I give you a little bit more background as to what we're going to cover, just want to make sure that you can hear me. So please let me know via the questions panel, where are you joining us from today? The questions panel will either be on the top navigation or the right-hand side. Ultimately, it will depend on how you logged in. Sometimes it appears a little bit different, even depending on the browser. So just so that I know that you can hear, where are you joining us from today? Wonderful. So I see folks are working remote. We have some folks from Mass General Brigham, a couple more that are remote from Cambridge. Wonderful. Thank you so much. So just like you let us know how you're joining, this is the same way you'll be able to provide that's the same way that you'll be able to submit questions throughout today's presentation. Okay, and I do see a couple of questions about the presentation and the PowerPoint. So what we're going to do is we're actually going to send everyone an email later today with the presentation so that you have access to it. We also will send you a link to a recording that we have as well so that you'll have access. And that email will come directly from my email so that if you have any questions or think of something in the future, you can always feel free to send me an email directly and I'll do my best to help you. So I guess now that we see where folks are joining and that I see that the questions panel is working, we're going to get started by letting you know a little bit about who I am and where I work. But before I actually even get into that, I want to remind you that today's presentation is brought to you by the Employee Assistance Program. And we do have Kim Smith, who is going to tell us a little bit more about the Employee Assistance Program towards the end of today's presentation. So please do make sure you stick around for that, but know that this is in partnership with them. So who am I and who are the folks at the Harvard University Employees Credit Union? So I am the Community Engagement Manager, which essentially just means that I work with our community to help bring free products and services to our communities to help improve their personal finance. So we do that in a variety of different ways. We are the same as a bank, and this is the same for all credit unions. So if you ever wondered, what's a credit union? How is it different from a bank? Pretty much a not-for-profit. That is the key. Credit unions and banks offer the same products, the same services, but credit unions are not-for-profits, financial cooperatives, meaning that it's truly owned and operated by the members of that credit union. And credit unions have what's known as a field of eligibility, or something in common that allows individuals to be eligible to be a part of that credit union. For us at Harvard, it is the university. So anyone that is affiliated with Harvard, including students, staff, alumni, the different teaching hospitals, are eligible to be a part of the credit union. Even once you lost that relationship, you're still eligible as long as you had a membership to begin with. That's essentially all that I will say specifically about us at the credit union. But if you have any questions, again, feel free to just send me a question. You'll also have my email, so if you think of something in the future, you can feel free to reach out to me. Now, why am I talking about student loans? I actually used to be the Director of Student Financial Services at a four-year liberal arts school in the Boston area. And before that, I worked for the Massachusetts Educational Financing Authority. So I have a lot of experience when it comes to student loans, and I have borrowed student loans both for my undergrad and grad. So not only have I been on the other side as when it came to awarding financial aid and helping our students, I have been a student and I have had my student loans and still paying them off. So this is something that's really close to my heart. And if you have a question that I don't know the answer to, most likely I will know someone who knows the answer. So feel free, this is all about you, and that's what we're going to cover today. So we're going to go over a lot of information about the student loans, but I did want to let you know that in addition to this presentation, we also have other presentations on our EAP page. So if you go to our website, huecu.org/EAP, which is exactly where you registered for this one, you'll be able to see the presentation slides for this presentation, and you can also register for upcoming sessions. And if you have other topics that may be of interest, and Kim will probably speak a little bit more about this when she speaks about EAP, do contact your EAP, contact us, because we're always looking to improve the presentations that we're offering you. So if there's something that we're not covering that you want us to cover, please let us know. Okay, so what exactly are we going to cover? So I'm going to walk us through the student loan repayment process. And I am talking general student loans, but I'll get into more specific. But before we get into, okay, how do I repay? We first need to understand our student loan. So I'll start us off with that. Then we'll talk about the different repayment options. We'll talk about that Federal Student Loan Forgiveness Program, PSLF, or Public Service Loan Forgiveness. We also will talk about refinancing, when it may make sense, when will it not make sense. I have another resource for you, and you'll get this again in the email, but if you wanted to, you could also go to our student loan repayment and refinancing page, where we've actually outlined these different steps. So if it's easier for you to see that information in a web page, we also have that, and we also have a handout, which I'll show you in the upcoming slides as well. So we have you covered via webinar, handouts, web page, recording. We really are here to try to get as much information to you as possible. So what exactly are student loans, or what are the types? Before we understand the best way to possibly repay our student loans, we have to realize that there are different types of student loans. You have your federal student loans, and these are the ones that when you complete the free application for federal student aid, the FAFSA, these are the ones that were awarded to you. They include the subsidized and unsubsidized, which are sometimes, well, they were known as the Stafford loans. So depending on when you went to school, or if you are a parent and are helping a child pay off their student loans, or maybe you took on some student loans yourself, they might have been awarded to you as Stafford loans, but now they're called direct subsidized and unsubsidized loans. There are the Perkins loans, there's the PLUS loan, and I'll get into much more details, but I just want us to understand that these three specifically are federal loans. So these are through the federal government. Then states might have their own state loans. Then there are the private student loans. Now, private student loans basically means it's not a federal loan. Sometimes the credit unions, the banks, the Sallie Mae's, the Citizens, our loans at the credit union, those are all private. When we talk about the type of student loan, the reason that this is going to be an important piece is because there are benefits that are tied to federal loans that are not available to private loans, and vice versa. So there may be times that you might think, oh, I want to refinance because the rate is X% right now. It may not make sense because you could lose some federal benefits. Or if you're thinking about going back to school, those federal benefits may not apply to you if you switch your loan from a federal to private. Also, as we're going through today's presentation, truthfully, the bulk of what we're talking about will be mostly federal, with some additional pointers for the private and for the state. For the private and the state, it's private and state loans are pretty much like credit cards. Every credit card offer is a little bit different. So if we were to talk about credit cards, we can talk generally how interest rates work. We can talk about generally how you repay your credit cards, the type of points or rewards that may be associated, but I couldn't go through and tell you everything about each credit card, because American Express is going to be different than Bank of America or than our credit union credit card. And that's essentially how the private student loans work. Each one will have its own specifics that we just don't have that level of detail. But for the federal loans, which is the ones that we're really going to dig it deep into, those are more or less set in stone. There are some changes, and I'll talk about those as well. But the federal subsidized and unsubsidized loans, these are loans that you borrowed when you applied for financial aid. Student needed to complete the FAFSA. This is only in the student's name. Who is the borrower of the loan is also important, especially as you're thinking about repayment, you're thinking about possibly refinancing, because there are some things that you cannot do if the loan isn't under your name. For the federal subsidized and unsubsidized, it's always under the student's name, because it's the student who completed the FAFSA, it's the student who borrowed these loans. Now, what exactly is the rate? This is where it gets a little bit tricky. As a student, let's say I attended college for a traditional 4 years, and each of those 4 years, I borrowed the subsidized and unsubsidized loan. Now, subsidized and unsubsidized, so they're two separate loans. The subsidized, the government was paying the interest while I was in school. The unsubsidized, that interest accrued. Now, I took out subsidized and unsubsidized for 4 years, meaning I would have 8 loans. I could have a subsidized and unsubsidized for year 1, subsidized and unsubsidized for year 2, etc. So totaling 8 loans. Now, because I have those 8 separate loans, yes, they're all through the federal government, but they all could have a different interest rate. And because they have that different interest rate, even though I may be making one payment to my servicer, who's the company, and they are the company that manages your repayment, that could impact my options. I may decide if I have a subsidized loan from freshman year that was at 5%, I could also have an a subsidized loan from senior year that was at 3%. So if I'm thinking about repayment, even though they're all federal loans, they could each have a separate interest rate. And I'll break down more as to why this is in the upcoming slides, but I just want us to start off understanding that they're not all going to have the same interest rate. And there a question that came in, thank you. If you graduate school and then go back a few years later, does your federal loan go into deferment again? If so, for how long? Great question. So yeah, so what happens with federal student loans is that anytime you go back to school at least half time, the loans will go into deferment, meaning that that repayment is not required. How long will depend. You get a 6-month grace period. So think of the six-month period as kind of like a pause, a free pass, if you will. No payment is required. You only get one of those though. So if I went from, let's say I graduated in May, but I started my graduate program in June. So I was enrolled at least half time throughout. I have not used that grace period. And because I have not used that grace period, when I graduate, I still have that grace period. But if I am an undergrad, I graduate, I take off 2 years and I use that grace period. When I go back to school, I'm not required, but those undergraduate loans, once I'm done with being at least half time, will no longer have that grace period of 6 months. Typically, it won't be a grace period, it's just sort of the timing of it. You won't pay right away. It might be about 2 to 3 weeks, depends on when it's reported by the school. But you don't get that grace period multiple times. You get it only once. Now, this is going to be important because with the federal loans, private loans don't do this necessarily. Some might, some private lenders may not, but for the most part, private lenders don't do this. Meaning that if I'm going to go back to school and I have federal loans, I may want to decide to stay with federal loans because I may want to use that grace period in the future, or I may want to have them deferred when I'm a student. Good, another good question. Will your loan, while your loan is in deferment, will interest accrue? Thank you. So there are two different types of loans. There's the subsidized and the unsubsidized. Unsubsidized loans will always accrue interest, typically. And I shouldn't say always then, I guess. Typically, outside of COVID-19, like right now, the loans are at 0%. So right now, those federal loans, any of these, everything that I'm talking about is still applicable, but because of COVID-19, the federal loans have been deferred. So the interest rate is at 0%. So that right now it's not, but typically outside of the pandemic that we're experiencing, unsubsidized loans will accrue interest. Subsidized do not. Another question that came in, can you add all the loans together for one lump sum payment and one interest? Great, these are all wonderful questions, and a lot of it we're actually going to get into more details, but feel free to keep those questions coming. So yeah, so going back to, I'll go back to my example of I attended school for those 8 years, for those 4 years, and I have subsidized and unsubsidized, so I technically have 8 loans. Yes, you could consolidate them, and I'll talk more about that in the future in the upcoming slide as to why that may or may not be a good idea. But keep in mind that you may have one servicer, you may be making one payment, so I may be paying, I'm going to do very simple math throughout because it's just easier, but I may be paying $800 a month. So $100, I may think that $100 is going to each of those loans because that would make sense. I have 8 loans and I'm paying 800. But remember, they each have different interest rates because the interest rates for the subsidized loans are set annually. And because they have different interest rate, I could actually be paying $200 to the loans from freshman year, but $120 for the loans for for sophomore year. And all of this, the details you can get into your servicer's website. And the servicer is the company that you're sending the money to. Another question that came in, can you choose to take the 6 months grace, when to take the 6-month grace period? So typically you cannot. So the way that the the grace period happens, it's because they're federal loans, the schools, the universities, the colleges, they report on a monthly basis. Well, I shouldn't say monthly. The frequency will typically depend on the school, but the school will report to the Department of Education who is attending school at least half time. In that process of them reporting that you are attending, the servicer will automatically put you into deferment if you are attending at least half time. If you wanted to not be in deferment, you can contact them and see. You can always make payment. So you're not required to make payment when you're in deferment. I know I did this myself. When I was in graduate school, I was able to still make payments. So I did, and it helped tremendously. I actually paid my unsubsidized first so that that interest would not accrue, and it helped my repayment strategy. But I don't necessarily think that they would give it to you again. I don't think you can opt to move it forward because it's automatic. You can opt to make payments, but you can't essentially choose when that deferment period is applied. These are all great questions. Thank you, everyone. Okay, so I have a couple more that I'm gonna, feel free to keep the questions coming, but I am gonna keep us going because there's a lot more to cover. So then you have the plus and the graduate plus loan. Not gonna get into too much detail other than the graduate plus loan. If you went to graduate school, if you're going to graduate school, this would be under your name. For the federal plus loan, that technically stands for Parent for Loan of Undergraduate Student, meaning that if you were an undergrad, your parents would have taken this loan under their name. So if you're in a situation that you spoke with your family and you decided the student is going to be the one paying all the loans for their education, you could technically pay for the plus loan that's under your parents' name, but that loan will never be under your name. You would have to refinance, you would have to find another way, because if my mother borrowed the plus loan on my behalf, that loan is under my mom's credit report. It's under my mom's social security number. It is not appearing on my report. I could set up the payments so that they come out of my checking account. I can definitely do that. But if I don't pay my loan, it will reflect negatively on my mom. It would be that parent that took on the loan. This sometimes can be a little bit tricky when students are trying to get the parent to, when the student is trying to pay off the parent loan or take the loan from the parent. Typically the workaround is that they might refinance, but then it becomes a loan of the student and the parent, because that original lender has to typically be on the loan. And then after some time, maybe they refinance again, and then it's only under the student's name, but you can't transfer the loan. That's essentially the takeaway from that, is you cannot transfer that loan. It's not like an easy, like, oh, I'm gonna just transfer it. You have to reapply for other loans to do that. Okay, so I talked a little bit about this, but I wanted to make sure that I put in a slide for those that are not aware. The federal loans right now, the interest rate was changed to 0%. So, and I know I already said they were deferred, and I want to make sure I speak clearly to this. What the federal government did was that they reduced the interest rate to 0%. They did this so that the payments wouldn't be required, so that you're not accruing interest. And I know we are living through this, so we know there's a lot of things that are happening now that typically have not happened. This is an example of them. This has not happened before, but this was a result of the CARES Act. This is in effect as of right now through September 30th. There has been talk about extending this. It is an election year. There's a lot of things in the news right now. My biggest takeaway for everyone is to just keep an eye out. We don't exactly know what's going to happen next couple of weeks. The government knows that this is coming up. This is a hot topic. Will it be extended? Will it not? You know, we'll see. There have been things put into place to try to get this extended, but there's nothing official as of right now. I will say, if you're in a situation that past September 30th, you cannot pay, I guarantee you that in the next couple of weeks, the student aid website will probably have something up as to what the next steps are. The reality is, because they're federal, and again, we are all living this, so we have seen this happen in the past couple of months, there are a lot of things that may just come up essentially last minute. So we don't, I wouldn't be surprised if on September 27th they decided something. I wouldn't be surprised if October 1st they decided something. So just keep in mind that if you have the federal student loans, I would, just as a backup, have the funds available. So if you do have to make payment, you have them. But keep in mind that there may be changes coming because it's very much a hot topic right now. This is also something that I want to point out when I talked about the federal loans and the difference of knowing if you have federal or if you have private, because for those of you that have the federal loans, these are all options for you because you have those federal student loans. So right now would not be a time that I would recommend to refinance those federal student loans because you're at 0%. No private lender is going to, well, I shouldn't say no because that's a general, but most private lenders, I have not seen one that has been offering a 0% interest rate. Private lenders, I was doing some research the last couple of days, and the lowest interest rates that I've been able to find for fixed for top tier credit score have been around 3 to 4%, which are still low. That's not bad, but again, not 0%. So if you have the federal loans, if you think you're going back to school, these are all reasons to probably stick to the federal loans for now because the benefits are they're just greater benefits. There's more control with the federal government with what they can do versus a private loan. A lot of times the private loans are lent based off of bonds or based off of projections. So they have less flexibility as to what they can or cannot do. With the federal government, there's more flexibility there. Yeah. So the private student loans, not going to get into too much about this. We'll talk more about that in the upcoming slides. The biggest takeaway, like I said, with the credit cards and private student loans are very similar in the sense that each one will be based off of that lender. So the interest rate, the grace period, repayment term, all of that will be specific to your private loan. If you're not sure, I would recommend going onto the website or contacting your private lender and get the details, because those details regarding interest rate, the repayment term, that's all going to help you understand what the best option might be for you for repayment. There are a couple of things that I do want to make sure if you have a private student loan that is with someone else. So maybe it's your father and you borrow those loans together. If I borrowed a loan with my dad, I may have the option of having my dad released from the loan if I make 3 years worth of payments on time or 4 years. It depends on that lender. Not every loan offers that, but that is known as a cosigner release option. This might be something that if you are in a situation that perhaps your parents are approaching retirement, or perhaps they are going to make a big purchase, or they just essentially don't want to have the loan on their credit report because it does affect their credit score. It does affect their ability to borrow other loans. You may be able to release them from that loan. So you may want to look into that. And this is very common across the board, federal and private student loans typically. And not just student loans, truthfully, this is something for all debt. They usually will offer you an interest rate reduction if you set up automatic payment, having the funds come out of your checking account, savings account, sometimes credit cards, but typically it's from a financial institution and not such as a checking or savings account. Okay. I know that this can be tricky, so I wanted to give you a couple of other resources. The federal student aid website, which is if you go to STUDENTAID.GOV, here you can see all of the federal student loans that you have in one place. Because let's say that I did my undergrad in one institution and did my graduate school in another, or maybe I went to multiple schools for undergrad. I could technically have different companies, different servicers that I'm sending payments to. So that could get a little bit tricky. May not know exactly where all my loans are. If they are federal, they all live under the federal student aid website. And that's sometimes referred to as FSA. So if you hear FSA, that's the acronym for federal student aid. You can go to the student aid website and you can put in your information. And if you do not remember your FSA ID, which is the federal student aid ID that you use to complete your FAFSA, it's okay. You can just reset it through the website. But there you'll be able to see all of your federal loans. Your private loans and your federal loans will not be on the same federal website. Federal is just for federal. If you want to see your private student loans, the best place to go to or to see all of the loans is to pull your credit report. Something that is different as a result of COVID is now you can pull your credit report for free 1 time a week from each of the bureaus. This is, as of right now, they did this a couple of months ago, but it's through April 2021, but you could, and it will not impact your credit score. If you have not done this, I highly encourage you to do this, especially if you have the federal student loans that are at 0%, because you want to make sure that it wasn't reported as a negative payment. Because it's at 0%, because no payment is required, it should not impact your credit score. But, you know, life happens, humans make mistakes, computers make mistakes. So you just want to make sure that you're pulling your credit report and that it is not affecting your credit score negatively. Your credit score will not appear for free on this website, but you could typically get your credit score on other, you can typically get your credit score through your credit card company, your financial institution, and those are free. Those won't charge you. But the annualcreditreport.com is free, and it's the only source that is authorized by federal law. Okay, so I see a couple of questions that came in, so I'll just take a moment to take these. Do Graduate Plus loans apply to any type of graduate school? Oh, yes, good, yes. So yes, Graduate Plus loan would be for any graduate school that offers federal financial aid. So you could have a Graduate Plus and have been a medical dental school in the arts. So yes, it's essentially just like the subsidized and unsubsidized, that those were undergrad, Graduate Plus for any graduate program. Okay, there are a couple of questions that came in about consolidation. Yes, I will talk more about consolidation in the upcoming slides, but I'll hold that one. I won't get into the details right now because that could be a little tricky, so I will hold that, but I will answer that in the upcoming. Okay, great question that just came in. If I have a federal unsubsidized Stafford loan from graduate school and a Stafford subsidized from a graduate school that now Nelnet has, are these considered federal loans or private? Wonderful question, thank you. So that is why I wanted us to talk about them. Your loans are always federal if they are from the Department of Education. Nelnet is a servicer. Your loan is still federal. They are just essentially doing the behind the scenes on behalf of the Department of Education. So Nelnet, direct loans, Fed loan servicing, Great Lakes no longer, but Monet, like all of these are servicers. Your loans are still federal. So federal loans stay federal unless you refinance and bring them over to a private student loans. So think of them as three different categories. Federal being category A, and then everything else basically being category B. And a couple of good questions coming in about refinancing, consolidation. I will get into all of that shortly. Okay, so now that we have an understanding of, now that we have an understanding of what is the federal loan, let's talk about the different repayment options. Reminder, federal loans are the Stafford, which were known as Staffords, but they're subsidized and unsubsidized, the PLUS loan. All of those are federal loans. So these repayment options are applicable to the federal loans. I will not go into the details about all of these because, as you can see, it's a lot, and the website truthfully is the best source. The takeaway here is that because these are federal loans, you have typically more repayment options. Part of it is because sort of just how government works. When different people are elected, they have different ideas, so they might create a different repayment option. Also the flexibility with federal loans, you can add repayment options a little bit more easy. With private loans, it's just like a personal loan or like a car loan. Like if you take out a car loan today, you're taking that car loan, let's say for 5 years, that's your car loan. Like the lender isn't going to come back and say, oh, I'm going to give you another option of repayment. No, it's typically what it is. It's set. There are ways, obviously, that you can talk to a lender, but typically it's set. With the federal loans, because the amount of student borrowing increased, the needs changed, so they added additional repayment options. So you have the standard, which take the amount that you owe divided by 120, which essentially is 10 years, and then you get a monthly payment. You pay that across the board. If that did not work, then you had the graduate and extended, which shift the time that the loan is due or shift the monthly amount. Then you have the income-driven plans. I'm not going to get into all of these because you can see on the slide, there are a lot of different options. The takeaway here is that there were repayment plans that were created because students were unable to keep up with their payments in the traditional 10-year repayment. Because a lot of times the loan amounts were significant and it just did not allow for individuals, especially those that had just gotten out of school, to repay. If you are in an income-driven plan, you do have to submit information for this, but because you are submitting information, it could change your amount. So it could change the amount that you have to pay monthly. The income-driven plans, another takeaway is because it's income-driven, it could be a substantial change from one year to another if your income changed drastically, if maybe your marital status changes and how you're applying for income-based repayment. Income-driven, excuse me, not income-based. Income-based is a type of income-driven, but it depends on the income-driven plan. One of the important pieces, if you're in one of these plans, you could qualify for public service loan forgiveness, and I'll talk about that shortly, but keeping in mind that you would need to be in an income-driven plan. Okay. This is just an example to show you the range. I use this on the student aid website. They have since updated it, but you can go on and actually get your own customized information, and I'll provide that link to you shortly. But this is just to show you the range of payment options that you could possibly have if you had a $50,000 loan. It is based off your family size. It's based off of your state of residence. So I did specify one person, single, living in Mass, but this is just to show that it could be, about $575 or as low as $266 at the beginning, but the payments could, depending on the plan, increase. So that's something to keep in mind with these plans. There are times that you may have a hard time making payments. So I just wanted to just walk you through some general information about deferment and what this means. Deferment we've spoken about, it essentially means you're not required to make payments. The one that most of us are familiar with is that 6-month grace period that we've spoken about. But there are other opportunities for you to possibly qualify for deferment, such as if you're unable to find employment, if you are facing economic hardship, if you're serving on active military duty. The takeaway here, if you're ever in a situation that you're not able to make payment, you want to contact your servicer because they may be able to defer your payment. If you don't qualify for those deferment options, you could do a forbearance. Now, why is a forbearance, how is it essentially different? A forbearance, that interest is accruing, so it's not as financially beneficial. If I could, I'd rather go with deferment because my interest is not accruing, but for the forbearance, it is. However, it's better to do a forbearance than not to pay. So forbearance may require a little bit more paperwork, but essentially gives you an opportunity. If you're not able to make payment, you can take advantage of that. And that's important because, sorry, I always hate this slide because I feel like I'm always providing the bad news, but I'd rather you know now than be in a situation that this happens to you. And I've seen this happen, that individuals could have their wages garnished, they can have their tax refunds, Social Security benefits. If you default, if you don't make payments on your federal student loans, it's the federal government. It's the federal student loan. So the federal government, they'll find your money and they will trace it, whether it's reducing money from your weekly or monthly or biweekly payment, pays that you get, or it could be literally withholding your refund, which isn't technically withholding there. I guess they're just taking the money that you owe them, but there are other things that they can do. So that's why it's very important, if you have the federal loans, you always want to prioritize paying those. And if you cannot pay them, just working with the servicer, because I would hate to see, and I have seen this, that people are in need of their refund or Social Security benefits or something, or their wages, and they don't get to utilize those funds. Yeah, so we understand the type of loans that we have. We have an understanding of the options of the federal repayment options that are available to us. But then there's something else. You could, because they are federal loans, you could technically have the opportunity, or it could be available to you to have some of the loans possibly forgiven. Federal student loans have the ones that you see on the screen. Some that I will point out: teacher loan forgiveness, that's very common. Total and permanent disability discharge. These essentially mean that you would not have to pay. Closed school discharge, that has been in the news lately with a couple of schools that had closed and the loans weren't forgiven in a timely manner, but there are times that the loans you may not be required. These aren't very they're rare. They're not as common, but I do want you to be aware of them because you never know that some of these may apply to you or someone that you know. The one that is most common, the one that we get is a lot of attention about, the ones that you'll see and are going to keep hearing about the next couple of weeks, if I had to guess, is public service loan forgiveness. I will start off by saying that I am going to provide you the information as of today, as of what's happening, but keep in mind that this is an election year. Keep in mind that it's also COVID-19 is happening. So what is going to happen with PSLF? I don't know. I don't think anyone really knows. So just keep in mind that depending on where you are with your student loan repayment journey, some of this may not be applicable to you, or some of this may, and I'll help you understand where you might fall. So first, let's understand what exactly is PSLF. Public service loan forgiveness means that if I have a federal direct loan, so again, subsidized, unsubsidized, plus loan, Perkins loan, anything through the federal government that I completed my FAFSA, even if it's being serviced by Nelnet or direct loan servicing or Fed loan servicing someone else. If I have one of those loans and I have made 120 qualifying monthly payments, the qualifying piece means that that monthly payment would have been under an income-driven plan. So that means that I'm providing my income to the servicer. They are adjusting my monthly payment based off how much I'm earning. Oh, excuse me, that's the qualifying repayment plans, excuse me. And then the monthly payment, it just means that the payment is made on time. So it technically can be late, but I wouldn't recommend making your payment late. There's a little bit of a buffer, but if I'm making my monthly payment on time, they don't have to be sequential. So if I made payments, went to school or took a class, stopped making payments, and then made payments again, that is okay. The 120 payments do not have to be made on 1 month after the other. If you have if you've been given an opportunity to not make a payment and that is part of your agreement, that's okay, especially if you're in deferment, but it does have to be the full month, the full payment for it to count as monthly. And you have to be working full-time for a qualifying employer. Full-time definition can vary what our employer might define as full-time. For some, it might be 30 hours. For some, it might be 35. It doesn't necessarily have to be 40 hours. It could also be, essentially it will be based off of the federal guidelines, not what our employer may define as full-time. Qualifying employer means a not-for-profit, typically. Hospitals, higher education institutions typically falling under that. This is going to be probably, I would say, and I will actually take a moment and send this to you via chat, so bear with me as I type in and speak at the same time. But this is definitely one of the places that I would say, take this link, take some time over the weekend, tonight, whenever it's convenient to you, and go through this if you have federal student loans. This tool is going to be able to give you much more detail. It's going to give you details that I'm not going to be able to. I'll take as many questions as I can, but really this is going to be able to tell you if you possibly would qualify, what you would need to do. It's going to go into very specific details, and it's going to be based off of your student loans. So you can actually see all of those student loans that you have. Okay. So I'm going to take a moment here because a lot of questions that have come in. Okay. So I have someone that said that they were told that payments made during this CARES Act deferment would not count towards qualifying payment. If I know if this is true, I do not know if that is true. I would check with the servicer and I will see if I can find anything online. I have not heard that, but that also would not surprise me. It wouldn't surprise me if it does not qualify, but I unfortunately do not know at this point. Another question that came in, excuse me, that came in, yeah. Okay, I've heard people had difficulties filing earlier in this year. Is this still the case? Do you have recommendations? Okay, so thank you. This is essentially in regards to PSLF. Yes, public service loan forgiveness has been in the news. When it first came out, it was, a lot of people applied, very few qualified, and they have then gone in and made changes, and then they made some other changes. So it hasn't been the cleanest of programs. It has been something that has been made easier. So you are correct. It was a bit of I'll say it was a bit messy at first. And I was working in higher ed in the financial aid office when this happened too. So it was a lot. There were a lot of emails, a lot of listservs. So it was tricky. I think they've gotten better at it. They have moved it over to one service, or they've created this PSLF tool. The government has been making steps to make it easier. I don't know what's going to happen with this being an election year. I don't know what's going to happen in the next couple of months. So that's why I would say we're all going to learn it, unfortunately, together. Whether or not this makes sense to you, if you're someone that has been in the program and you've made, let's say, 100 payments, you only need 20 more. It might make sense for you to continue this route. If you're someone that hasn't made any student loan payments yet, or haven't had any of those payments qualify, your strategy may look a lot different in a couple of months when PSLF maybe gets a facelift. Maybe they give it a little bit of a change. So where you are in those payments may determine what route makes sense for you moving forward. Okay, another question that came in: what factors would allow for forgiveness with an income-based repayment loan? Okay, so I would actually recommend going onto the student aid website, because there are you can have loans forgiven outside of public service. If I had a loan and I'm in one of the other repayment options that I could have my loan forgiven, let's say I've paid my loans for 30 years and I still have a balance, I technically could have my loan forgiven after year 30. But that loan that's forgiven at that amount, let's say I had $10,000 loan forgiven, that $10,000 could be treated as, essentially it's treated as a forgiven loan. So it's added as taxable income when I file my taxes. So there are cases that you could have loans forgiven outside of public service loan forgiveness, but that typically will be based off the specific repayment plan that you're in. So I would recommend going onto the website, because it's just such minute details that I'm not an expert in the specifics of each plan. I will say with public service loan forgiveness, if you have those loans forgiven, the benefit, or why it's so popular, is that if I have $10,000 loan forgiven, or 50 or 100,000, it's not added back into my income. As a result, it allows you to, it's more beneficial. That's why more people like it, because you don't have that money added back in. Another question that came in: would volunteering in a public library count? It would not. You need to be working at full-time in an employer that qualifies. And I think a library probably would qualify, but you'd have to be working full-time. Okay, so I'm going to get into a couple of other questions that have come in. I know we had a couple come in about refinancing, consolidation. So I'll get into that section. Feel free to keep the questions coming. We have about 15 minutes, which I think will be sufficient time, but if you need me to stay on for a little bit longer, I am available as well. Okay, so refinancing. Had a lot of people talk about this, but I want to make sure we're all on the same page as to what refinancing is. Refinancing is taking debt that you have and bringing it over to a different lender, and you get typically a different rate or a different repayment. You can refinance a house, you can refinance credit card debt. It's just called typically a balance transfer or debt consolidation. You can refinance a car loan. If I refinance my student loans, it gets a little bit tricky with refinancing student loans, who are different, because I could take a federal loan and I can take private loans and I can refinance them together. So remember my different buckets. I have federal being bucket A, private loans being bucket B. I can take both of those and bring them over to us at the credit union. So I no longer would have to pay the federal government. I would no longer have to pay Sallie Mae. Now I would be paying HUECU. I've done a refinancing. What HUECU would do is pay off the federal government, pay off Sallie Mae. So now I have a new loan with that new company, HUECU in this example, who I'm paying. I get one payment. I no longer have multiple loans. Now that is refinancing. Refinancing, you can do federal and private. There's consolidation. Actually, I don't think let me see. Okay, I don't think I have the slide here, so I'll just talk about it here. There's consolidation, which is different. Consolidation is, let's go back to my first example. When I was an undergrad, I took out subsidized and unsubsidized loans each 4 years of school. So I have 8 separate loans. Consolidation means that I would take those 8 separate loans with the federal government. So you can only consolidate with the federal government. You don't consolidate with anyone else. Consolidation only happens within the federal government. I could take those 8 separate loans and combine them into one and make one payment. The benefit for me is that instead of having my payments split up against around 8 different loans, they're now one loan. It's a weighted average interest rate. Truthfully, it's just simpler. It's simple. It's just easier. But that may not make sense. So if I am trying to do public service loan forgiveness and I have made, actually, let me step back. Remember, with refinancing or with consolidation, they both equal a new loan. So I'm paying, because what happens is that you go to a different lender, that lender basically pays off your other loans, and now you have a new loan. So lender A gets paid by lender C, lender B gets paid by lender C. Now I have a new loan with lender C. Because I have that new loan, that's literally a new loan. So it's new rules, new benefits. So if I consolidate my loans and I had made already 100 payments towards public service loan forgiveness, if I consolidate, that's a new loan. So because it's a new loan, I essentially could lose those 100 payments that I've made that were counting towards public service loan forgiveness. If you are thinking about, if you're in public service loan forgiveness and you're thinking about consolidating or refinancing, if you've made significant payments and you want them to count, I would not recommend doing that. I would recommend talking to your servicer because they can give you much more specifics, but typically that you could lose those payments. And if you take a federal loan and bring it over to a private lender, you would lose the deferment option. You would lose the income-based driven benefit. So all that information that we spent a good amount of time talking about at the beginning, the reason for that is that if you refinance, you lose those benefits. So you just want to make sure that if you're going to refinance, that it makes sense. Right now, federal government 0% interest rate, refinancing, I wouldn't recommend it for a private company because you're not going to be able to do that. Also, the repayment typically will begin right away. So let's say that, you know, in 2 years from now or a year from now, things are much different and the refinancing rates are great, the federal government rates have gone back to normal, and you think about refinancing, but you're also thinking about going back to school, you lose that grace period opportunity while you're in school if you go to a private lender. Sometimes they might offer it, but typically they don't, and typically repayment begins right away. So there's always something I tell students that are graduating. If you're graduating in May and you refinance in June, you're probably paying in July. You might want to wait to refinance in October, or when that 6-month grace period is almost over. Other general things to consider: refinancing a loan is just like any other loan. So you want to try to have a high credit score, want to understand the interest rate. Right now, the variable rates are fairly low because of the way that the market is. Keep in mind that the variable rates will change, hence variable. So it may make sense if you have a low balance and you define that. So maybe you have a balance of 5,000 and you decide, I'm going to refinance for variable because worst case scenario, if the rates go up, I could just accelerate my repayment. That can make sense. But if you have a loan balance of $50,000, going to a variable rate may not make sense, because if that's the amount that you have and you're not able to easily pay off $50,000, which most of us can't, if you can't pay that off, then you might be stuck with a variable rate and may not be able to keep up with your monthly payments. Typically, lenders will not offer prepayment penalties, but you always want to double check that. I know we're going through a lot, and I'm going to open it up to questions shortly, just finishing up here a couple more slides. But one of the resources I wanted to point out, and I will take a moment to just type this into the chat so that you have it, is Green Path Financial Wellness. They are accredited credit counselors that can provide free financial information. They could do budget, they could do COVID counseling, they can review your credit report. They do all of this for free. We pay for it at the credit union, so it's available to you for free. They do student loan counseling as well, but I don't recommend that one. you have to pay for that one. It's about $50 a session. But typically, I would say you can go and take advantage of the free resources, such as this. There's stuff on our website. But if you are not sure about credit, or if you just have general questions, you're trying to find more funds to apply to your student loan repayment, GreenPath is a wonderful resource, and it's for you and anyone in your household. You do not need to be a member of our community, of our credit union, though we would love for you to be a member, but we believe in this strongly, so we make it available to all of you. Okay, so I just wanted to show sort of what does refinancing look like. I'm a numbers person. It's just easier for me to visually see things. So this is an example. If you had a $40,000 loan, and this is interest as of this amount, not prior interest, but moving forward. If my interest rate were at 8%, if I refinance, brought it down by 3% to 5.5, my monthly amount can change. My loan term, if I wanted to pay it in the same time, it would save me about $6,000. Or typically what happens when you refinance, they'll give you a new term, which is usually 5, 10 years, 15, usually a number that's divisible by 5. It will show you here that you can save about $4,000. Even if you go down by 1%, you could typically save some money. If you have a student loan rate, anything about 5%, I probably would look at it. Again, not for the federal loans because those are 0% now, but if you have a private student loan, anything above 5%, I probably would look at it. And while we're talking about refinancing, just in general, if you have a car loan, I know our rate right now is like around 3%. So if you have a car loan, anything about 3%, probably want to look at refinancing. If you have credit card debt, definitely. The rates are just really low across the board. Mortgages especially, you can have mortgage rates in the 2% right now. So if you have any other type of debt, I know this is student loan specific, but sometimes to pay off one debt, it may help you to refinance another debt because then you can have a higher cash flow. So look around if you have any debt, because right now the rates are really low. As I mentioned, we have a couple of different resources on our website. Another one that I'm going to put in the chat for you is we have put together a student loan repayment handout. So it essentially just goes through what we talked about, gives you a couple different links. It's a good starting place. Keep in mind, this was created pre-COVID, so it may be that, I believe all the links are working, but some of the information, it doesn't speak to the rates being at 0% right now, but I know I've mentioned that a couple of times. I'm going to turn it over to Kim so that she can talk to you a little bit about EAP. And while Kim is talking to you about EAP, I'm going to just read the questions and then I'll take some of those questions that came in. So as Kim is talking to us about the many resources that EAP has to offer, feel free to add your questions and then I will start answering them. All yours, Kim.
Thank you so much. Thank you for joining us today. So just quickly gonna go over our EAP resources. So the EAP stands for Employee Assistance Program, and we provide work and life resources to all employees of the Mass General Brigham hospitals, as well as direct household members over the age of 18. So that's spouses, or partners who live in the house over the age of 18. So how can EAP help you? We offer one-to-one short-term solution focused counseling. So if you're having, more stress than usual, want to kind of talk through a life situation or a work situation, we can certainly do that. We also do warm handoffs and referrals to the community for additional psychotherapy referrals. We do manager consults, we do group supports, and we provide critical incident staff supports in person or via Zoom due to COVID. And we have a large, just a vast amount of resources for employees. So this looks like anything from needing information around childcare and parenting, legal, financial, and a variety of COVID-related content as well. One of the nice things that we do provide is 24/7 coverage for employees to call and talk to one of our licensed counselors. We have a staff of about 18, and that 24/7 coverage is actually offered by our employees. So not a third-party contract. We are answering the phone, whether it be after hours or on the weekends. On our website, which I believe, yep, it's listed right here, so eap.partners.org, you're going to find a lot of content that is vetted by all of our staff. Most of the content right now that is being used by employees is the Stress and Resiliency Seminar Series. These are anywhere from 5 to 10 minutes and would look like yoga at your desk, some guided meditations. So just little opportunities for you to take care of yourself throughout the day. They are pre-recorded as well. So if you can't attend the live sessions, you can certainly access them through the link there. But we also just, we offer webinars like today, as well as things touching on employee well-being, fighting the financial fallout from COVID, tobacco cessation, cultivating optimism, burnout, etc. So if you have any questions, please feel free to give us a call at that main number. That number that's listed right there, the 866-724-4327 number. You can call and ask questions about what is available, and you can also call and ask to set up a first-time appointment as well. So we are here to support you in any way that we can, so feel free to reach out if you need us.
Thank you, Kim. And thank you
Sure.
everyone for all your questions. So I'm going to answer some of these questions, but if you have any questions for Kim, I know Kim's going to stay on for a little bit longer too.
Yep.
So if you have any EAP questions, feel free to submit those and I'll make sure that Kim can answer those for you. Okay, so I'm going to get into a couple of questions. We had a lot that came in, which thank you, because there's a lot to cover, so it's helpful to get the questions. I'll sort of, no particular order, but there was a question about getting this recording. So what I will do is most likely tomorrow, I don't see myself being able to get it done today, unfortunately, but we'll try my best. But if not, definitely by tomorrow, you'll get an email. Everyone that registered will get an email with a link to the presentation so that you have it. You'll get a link to the slides so that you have them as well for your review. And that email will come from me so you can reply directly if you have a question. Another question that came in, is a credit union considered a private lender or do they function as a loan servicer? So anything that's not the federal government is considered a private lender. So even though a credit union is not for profit, we are still a private lender because we're not the federal government. But as far as the servicer, typically, and you'll find this with most financial institutions when it comes to student loans, they might have someone else that services, which basically means that your payment may not be going to that lender, it's going to a company that essentially processes, but that's essentially the same thing that the federal government does. How do you find a lender to refinance with? The best thing I always recommend is starting locally, and I mean check your financial institution that you primarily bank with, check credit unions, check other in the area. And then you can, there's NerdWallet does a good job of providing resources so that you can see bank rate, that you can compare different rates that are out there. Keep in mind that they're always going to, not always, but typically the lowest rate that you see is the promotional rate that may be applicable only to those with high income, sometimes higher incomes or the highest credit score. If you are going to apply for various loans, try to do so within a 2-week period so that it doesn't impact your credit score substantially. Anytime you apply for a new loan, it will impact your credit score. But if I am shopping around and I'm applying for student loans at multiple lenders within that 2-week period, it's understood that it's that I'm shopping around, shopping for rates. So it's only treated as one inquiry versus if I applied for a student loan every month, that would be 12 inquiries. But if I do 12 within a 2-week period, that would be one inquiry. When refinancing with the lender, what will I need to bring with me? Well, a lot of this is online, so you actually don't have to go anywhere. You can do all of this online. Yeah, and typically they will tell you, they usually just pull your credit report and you may have to proof of income as well. You may have to do that as well. Okay, another question that came in, are we able to reach out to you with questions even if we don't have an account with the Harvard Credit Union? Yes, you can. We, as the Harvard University Employees Credit Union, we're here for a resource for all of the partners, partners. We're also here. So even if you're not a member, we would, obviously love to have you join us. But if you're aren't a member, we still are here to help you. That's one of the benefits of being a not-for-profit. Another question that came in, if I worked at BWH, Beth Israel, and MGH Brigham, could I still sign up for public service loan forgiveness? Or do you have to be at one company for 10 years? Thank you for that question. You do not need to be at one company for 10 years. And I also want to point out, it's not the 10 years, it's a 120 payments, because technically if it was within 10 years, you probably would be done with your loan if you were in standard, but it's 120 payments, which could span over, it could be 15 years, it could be 13 years, but you do not need to be at the same employer. I have a medical school debt, quite high balance, consolidated. I likely qualify for public service loan forgiveness, but not enrolled. Do you have to be enrolled, or will they look at your service retroactively, and will the entire balance be forgiven or only a portion? Wonderful. Thank you for bringing this up. I would recommend going to that student aid website /PSLF, because they can, and this is typically what has happened, is you can have them proactively, payments that you've made, sorry, not proactively, retroactively. So if I've made, making up numbers, if I've made 50 payments that would have qualified, that could count towards my public service loan forgiveness. So it's not as of when you enroll in the program, and technically you're not enrolling in a program. You have to, the first step is to essentially see if your payments qualify. So you complete an employee certification document, which is on that PSLF website, which is very simple. It's so simple. It's basically demographic information. You have someone in your hospital, and typically the HR office, that will complete it, or essentially say that yes, you've worked here for X number of months. So it's fairly simple. It's something I highly encourage everyone to do. But that essentially creates the calendar. It starts the tracking of your payments. And when you log on to student aid website, you can see how many payments you've made that qualify. And if you need to dispute those, you can. There have been times that some payments were made that they weren't counted and they should have. So it does take some due diligence, so you want to double check. But in true public service loan forgiveness, it would be your entire balance that would be forgiven of those payments that would qualify. Another question that came in, my son had federal student loans and state loans that required a cosigner. He is now permanently disabled. The federal loans were forgiven. Is it possible to have the state loan forgiven? I would contact the lender, because state loans, it depends. I know personally some lenders, and I've worked with some institutions across the country, and I've heard firsthand that some lenders will forgive loans if individuals are disabled and can't make payments, even if it wasn't a part of the agreement. Sometimes sort of the goodwill, depending on the balance, if they've made, so every lender will be a little bit different. I know typically the nonprofits will have a little bit more flexibility, but not always, but just it will depend. But I would encourage you to contact the state lender, and especially because they won't know, and this is something with federal student loans, especially if you're making the payment on behalf of your son, they don't know that they're just getting a payment. So they might not realize that the student isn't the one making the payment. So I would highly encourage you to contact them directly. Okay. So I'm looking at the time. I know I went over by a couple of minutes. You had wonderful questions, so thank you, everyone. I don't see any additional questions, so I wanted to thank you again for joining. Kim, feel free if there's anything else that you would want to add. But everyone, thank you again for joining, and I will do my best to get this to you definitely by tomorrow so that you have the information as well. Hope everyone has a good afternoon.